Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Scale Without Compromise, how $40 billion Lido Advisors stays client first. It's a conversation with Jason Osier, the founding partner and chief executive officer of Lido Advisors. I'm Jason Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
Over the last decade, scale has become one of the defining themes in wealth management. Larger firms promise broader resources, deeper infrastructures, and expanded opportunity. But they also raise a fair question. At what point does growth begin to work against the client experience it's meant to enhance? That tension sits at the center of today's conversation. Jason Osier and his partners at Lido Advisors have built one of the largest RIAs in the country, managing more than $40 billion in client assets while maintaining a family office mindset and a distinctly client-first culture. What's notable is not just the firm's growth, but how intentionally it has been pursued. In this episode, Jason and I talk about what scale actually enables when done thoughtfully, and why bigger is better is an oversimplification. We explore Lido's approach to integration versus aggregation, how the firm evaluates acquisitions, and why culture, not capital, is the real constraint on growth. We also discuss the role of the wirehouses in the modern landscape and how the RIA model differs, and the evolving role of private equity in the RIA space, how Lido has structured ownership to align advisors and employees, and why access to capital doesn't have to come at the expense of independence or client outcomes. Jason shares how technology, data, and in-house capabilities support advisors at scale, and why staying close to clients remains central to his role as CEO. It's a candid look at what sustainable growth actually looks like, and what advisors should consider as firms across the industry continue to get bigger. So let's get into it. Jason, thanks again for joining us. Thrilled to have you on. Can you start by just walking us through your background? What brought you to the world of wealth management?
Thanks for having me on the show, Jason. So I began my career actually as a CPA, doing audits and tax returns of hedge funds, which really gave me a strong technical foundation and a clear understanding of fiduciary responsibilities. I actually left public accounting to go run a family office back in 1999 here in Los Angeles. And that really gave me a good understanding of what families are looking for, the types of investments, bespoke opportunities. And that's how I got introduced to Lido. Lido was well known in the family office space. And I used to go to their events and their family office conferences. And I became very close with Lido's founder, Greg Kushner. And after going to his events for 6-7 years and collaborating on many different investments, he made me an offer I couldn't refuse to cut my pay by 60% and join Lido way back in the day when we had 6 people and only $300 million under management.
Wow. Well, I imagine the firm then, I was going to say, is very different than it is today. I want to get to what makes Lido special, what makes Lido unique. Before we do that, can we just provide some background? I think most people in the industry have probably heard of Lido, but just provide some context for size, the services you provide, Anything else you think our audience should know about your firm?
Yeah, Lido originally was a multifamily office, and we had one office here in Los Angeles. And over the years, we have turned our firm into a national firm. We have over 40 offices around the country. We are managing somewhere north of $40 billion today. We have over 450 employees, about 200 to 250 shareholders. We are on our second round of private equity firms. And one of the things that I am most proud about is that at the last transaction, 74 people in our company became millionaires. So we
Wow.
are half owned by private equity and roughly half owned by the employees of the company.
Yeah, and I will certainly ask you about private equity. Perhaps you've heard this one before. It's become a little bit of a dirty word in the a dirty phrase in the industry. So we'll get there. Even shorter, give me the one sentence kind of elevator pitch. Lido Advisors is, do you define yourself now as an RIA? Like, tell me just briefly how you think of your firm.
We think of ourselves as an RIA and a multifamily office, and our service offering is anchored on what we call Lido One, a fully integrated platform that brings together wealth management, financial and estate planning, tax consulting, tax preparation, trust services, and truly what is our differentiator is a proprietary investment platform that includes both traditional and alternative investments. And the real value is how we bring these services under one framework. And 99% of it is going to be done inside our office as opposed to outsourcing it to third party firms.
Was that kind of integrated family office slash RIA vision? Has that been your vision from the early days, 25 plus years ago, or has the vision morphed over time and that's what you're articulating is today's vision?
It was our vision back in 1999 when Greg started the firm. It was our vision in 2009 when I joined the firm. I would say the big difference between then and now is we've significantly increased our capabilities internally versus utilizing lawyers externally or CPAs externally. And we certainly have a full suite of attorneys and CPAs that we use externally. But a lot of what we do from a financial planning and a tax and estate planning perspective is done in house. And that has morphed and evolved over time.
I think also, at least from my perspective, a lot of what Lido's become synonymous with is acquisitions. Was the acquisition piece an important part of the strategy? And you smile as I say that. Maybe that's not what you want to be synonymous with. So give me your thoughts on that. And I'm just curious to hear. We'll talk more about your M&A strategy.
Yeah, from 2009 up until 2017, we did exactly zero acquisitions. So acquisitions and M&A was never part of our strategy. When I first joined the firm and we had $400 million under management, I think our revenue at the time was 1.5 million, which was very thin and skinny for six people inside the company. Our goal was to always, we just want to hit $1 billion of AUM. You know, once you hit $1 billion of AUM,
Magic number. Yeah.
it's a magic number, and you start to scale, and before you know it, you sit around with your other partners like, oh my God, we're at 2 billion, then 2.5, and 3 and 5. And when we hit about 5 billion, we started to have discussions internally about M&A. Why should we do M&A? What are we trying to accomplish by doing M&A above and beyond just asset gathering? And we made the decision when we were at about 5 or 6 billion that we didn't want to be an aggregator of capital. We wanted to be an integrator of capital. So when we are fortunate enough to win an initiative on the M&A front, we want to integrate that firm. One flag, one name, one banner. And so far, we've been extremely happy with the results of M&A. And firms who join us, they learn how to integrate into the Lido One model, integrate the investments into the Lido investments. You go to a Lido office in Texas, it feels very similar to the Lido office in Los Angeles. So there's this commonality that we've built
Mm.
throughout the firm. I don't want to use I'm not going to use McDonald's as the example where the French fries taste the same in Beijing as it does in Los Angeles, but maybe more like Ruth Chris. The stakes are very similar, whether you're in Chicago or you're in Los Angeles.
Well, you had the high end chain prepared on backup there. That's actually a very good analogy. First of all, I completely agree. The acquisition model in and of itself is not much of a strategy. Growth for growth's sake is not much of a strategy. The perception I get from the outside looking in and seeing what you've done is a firm you acquired, let's say 3 years ago, should not look like a firm that's been acquired. It should look like a part of the Lido family, of the broader Lido. So in that regard, you've built this cohesive multifamily office slash RIA. I hear you on the Lido one. I hear you on the alt platform. A lot of firms and a lot of RIAs, I think, would say similar about their capabilities. What do you think is like the secret sauce differentiator of Lido versus even in your market, your headquarters market, Southern California? It's a saturated market of RIA slash family offices. So tell me what you think is the unique differentiator.
First and foremost, it's our people, our client first culture. The client is always right. Rule number one. Rule number two, client is always right. Rule
Rule
number
number
three,
one.
same. And so our people. The firm was originally founded by attorneys and CPAs, which really instilled a fiduciary culture within the firm. And from there, we've done a really good job in recruiting the right types of people into the company who understand it's the client first, it's the firm second. And if you put the client first, the firm second, and themselves third, good things are going to happen for everybody. Which again, going back to the 74 people, became millionaires overnight because of the distribution of real equity up and down the firm has really been an advantage. And also the innovation that we've been able to instill in the firm. Our chief investment officer is absolutely brilliant. He's not just a CIO who can talk investments. He also does a lot of internal coding. A lot of our technology has been built by him for
Wow.
systems, our trading, our unique investment offering. And it's really to have individuals like him who share the same passion has really advanced our firm years ahead of where we normally would be.
Yeah, I think it's a great answer. And it ties in. I was going to ask you, I was on your bio a couple weeks ago as I was preparing, and your tagline or your bold headline in your bio says Jason gives the majority of his time and consideration to his clients, even as he leads Lido as CEO. So I take that to mean that you still maintain a book of business.
Yeah, sometimes not by choice, but I originally started as an advisor and the chief investment officer of Lido way back in 2000.
Interesting. Tell me more about the client centric and how you approach both roles.
When you have 6 people and 400 million under management and 1.5 million of revenue when you started, you got to grow the firm. I had a unique specialty in an alternative investment. So I really helped build out the alternatives platform in our firm back in 2009, 10, and 11. But along the way, I would take on clients because I am a CPA by background. I understand a fiduciary relationship. And I always believe that it's really hard to run and lead a firm from the top if you're not taking on clients, if you're not in the trenches, if you don't have a deep understanding of what clients are looking for, what clients are looking for on the estate planning side, what clients are looking for on the investment side. And I still work with clients today, number one, because I don't want to abandon people who've been with me for 10, 11, 12 years. I have close relationships with these families, and it really gives me a better understanding of what's going inside our firm and outside of our firm.
I love the answer. We've had a couple of president CEOs on the show, and surprisingly, a lot of the Raymond James executives are actually still in production. And one of the reasons it kind of reminds me of your answer is stupid example, but even knowing how to put a trade in, or like when the compliance system isn't working properly, like how does that feel? What is that experience like? You can say, I've lived it, I've walked it. You know what the real pain points are for an advisor because you're able to look them in the eyes and say, I am one too. So I assume it's not an accident. You had that highlighted on your website, client centric. It seems like that's the cornerstone, like people have their pillars. Client first seems to be Lido's number one.
It is our number one, client first. And the tagline, always do the right thing. That was instilled in all of us from when I joined in 2009 from Greg Kushner, the founder. And that has been passed on to every single person inside Lido. Always do the right thing.
How do end clients, though, not financial, we spend most of our time candidly speaking with financial advisors, but I'm always mindful of the fact that financial advisors in and of themselves have end clients. And I imagine that many of Lido's end clients came from the bigger brokerage world. Not all, I'm sure, but I imagine many of the clients are ex Morgan Stanley, ex UBS, ex Wells, ex Raymond James types of client. Is there any education that goes on around the RIA space, around the brand or lack of brand? Like, tell me what the client reception to the story generally is.
That's a really good question. Certainly, when you think about the Morgan Stanleys, the Merrill Lynches, the Goldman Sachs, there is an element of brand recognition, instant comfortability from the client that, okay, my money is at Morgan Stanley or Goldman Sachs, and there's a perceived level of safety with that. And I do think the RIA community, it's taken time for that concern, if I may, to be overcome over time. But we always tell our clients separation of church and state. We are your financial advisor. We are your family office. But Lido is never going to take custody of your money. Your money is always going to be at a third party custodian like Schwab or Fidelity. You're not giving your money to Lido. Your money is going to sit at Fidelity. And we are the advisor. The account is going to be in your name, not in our name. And when you start explaining that to the
Yeah.
clients, they start to get more comfortable with a relationship with Lido or any other firm for that matter, where, yeah, you might have 10, 20, 30, 40, $100 billion that you're managing, but it's a name that they've never heard before.
Yeah. No, it's a really interesting point. I wonder, well, it's your answer. Do you think that story's gotten easier to tell, or have you had to tell it less as the space has gotten more, I don't know if mainstream's the right word, but it's definitely gotten bigger? Like, are clients more receptive to these conversations today than they were 10 years ago?
It's a difficult question to answer. Now that we're managing over $40 billion, it's easier for us.
Yeah,
Eh,
fair. Success begets success a little bit.
Yeah.
Yeah.
And number one, the clients will do the research. Wow, they're managing $40 billion. They log on to the SEC website. They see there's no issues. But, when we were a billion or 2 billion, yeah, it was much more difficult, especially on larger clients and larger opportunities to get comfortable. But success begets success, as you mentioned, is very true.
I think it's a really thoughtful answer that it's not necessarily that the RIA space has gotten bigger, which I think it has, or that the custody conversations have gotten easier, but it's that your firm has gotten bigger and more established. And so some of those sort of like startup-y types of conversations you may have to have with clients. I ask because a lot of our advisors are currently at the big firms and they're contemplating breaking away. And one of the things I think they worry about in breaking away from a Morgan, a Merrill, a Goldman, whoever, is this brand question, and or tied to that, how do I approach that custody conversation with a client? That's a different muscle to have to flex for a wirehouse advisor.
Absolutely. And at the end of the day, clients who are with Goldman Sachs or Merrill and all the usual suspects, whether the money's there or at Schwab or Fidelity, which are the two biggest custodians, they
Right.
feel just as comfortable. And Schwab and Fidelity generally aren't selling them products like some of the other larger firms. And clients are pretty well informed on that now. They like the fact that it's an independent custodian for all intended purposes.
That's my view too. Is there an extra conversation involved? Maybe, but is it typically a deal breaker or even a serious friction point? Typically not. So I appreciate the answer there. I want to shift gears now. Let's talk a little bit about private equity, M&A, and the like. Let me start with, I think this is a softball. Is your view bigger is better? Let's keep acquiring as much as possible, or is it more nuanced than that?
Definitely not bigger is better. Now, there are definite benefits to scale. With scale, you can have better resources internally. You could insource the tax preparation. You could insource the legal. You could insource a lot of the advanced wealth planning. So there is a benefit to scale. But, when we started down this route in 2020, when we made the decision, we needed a financial partner because our personal balance sheets would only get us so far from a credit perspective.
Right.
And we searched and we went through a very, very robust process during COVID. And we found Charles Bank. And we found Charles Bank, which is a middle market private equity fund, when we had about 7 billion under management. They gave us access to capital that we otherwise couldn't get through the private credit markets.
Right.
And we judiciously used the capital when we found firms that wanted to integrate into the Lido ecosystem, as opposed to just buying a firm or buying a bunch of firms that are all doing distinctly different things and might have different P&Ls. We went a lot slower than probably other firms to be very, very smart in who we acquired, how, and what was the why. The important part of our acquisition was, did they share the same culture as us? Did they share in a growth culture? What was the why? How did they better our firm? And so that integration is so important to the success when you're doing M&A.
So it sounds like, and I think that's the right, like you basically look at each opportunity on their own merits, but you do acknowledge, like I think that was a thoughtful answer to say, we're not naive to the fact that you do need scale and there are benefits to M&A. And oh, by the way, in order to do M&A well and do it successfully, you really need capital backing, which usually means private equity. But I want to pull on that thread a little more. So you started with, what did you say, during COVID, your first private equity transaction.
Yep.
We know typical private equity time horizon is, let's say, 5 to 7 years. Talk us through then the next chapter and then the next chapter ahead because this is what I think people worry about is like, okay, fine. If private equity recapitalizes, I can probably live with that. But what about if the private equity fund turns around and sells to Merrill or something like that, or something else that I don't find all that palatable and it's super disruptive to me?
Yeah, that was in our contract with Charles Bank, as it is with our new partners, HPS, that they cannot sell to a Merrill or a Goldman
Interesting.
Sachs. Again, great firms. It's just not for who our clients want to be with. And culturally, I don't think that would fit in with why advisors signed up with us. And to your point on M&A, every opportunity is evaluated on its own merits with a focus on cultural alignment. And the cultural alignment of our advisors is to remain independent. And so merging with a much larger firm, I don't believe is ever in the cards for Lido. I never want to say never, but remaining independent, really who we are and where we want to be.
So how do you get advisors comfortable with that? Because I'm only pulling on this thread so much because we get asked about this a lot and a lot more these days post LPL Commonwealth. Just seems like a lot of attention on this like acquisition, who backs your firm, what's your next steps conversation. So I'm wondering when you're talking to an advisor who says, I'm worried about it, like, were you able to point to your previous private equity recap transaction and say, like, not only was that not disruptive to our advisors, but actually, as you said, we made millionaires out of a lot of them too. Like, do you talk about through a positive lens as opposed to my leading questions, which are making it sound like a negative?
Yeah, we have great data to support that thesis, Jason. When Charles Bank came into the company in June of 21, maybe there were 15 to 20 shareholders, and we created a management incentive program where we were able to distribute very sizable amounts of equity up and down the company and reward people for not just production, reward people for client retention, and reward those who weren't working with clients for longevity inside the company. And so we were able to point to the number of shareholders we had pre Charles Bank. And after being with Charles Bank for 4 or 5 years, I mean, it was 100 and something shareholders inside the company. And then you were able to actually show data on the different sizes of equity given out, the value creation, the size of the equity those got. And again, the 74 millionaires, I mean, people value equity today. And I will tell you, they value equity a lot more today than they did in June of 21 when they received a stack of legal forms they signed and no one truly understood the value, but they do today. And so now when we just went through another transaction with HPS and we got more management incentive shares to distribute, people want them. They believe in them.
I bet, and I think it's part that people believe in them, and also it seems like equities come back in vogue because there's been now, I think, enough precedent of even somewhat large firms continually raising capital at higher and higher multiples and higher levels. So equities, and don't get me wrong, no advisor we work with is ever like, give me 100% of a deal proceed in equity. Everybody wants cash. I still think cash is king. But it used to be like negotiate for as much cash as possible. That was the name of the game. And now it's no, let's take a shot. Like it's a slug of equity, I think is a good thing. You agree with that sentiment?
I get really excited when we're working on an acquisition or someone's leaving a brokerage firm and joining Lido. And it really excites me when I hear they only want 20 or 30% in cash and 70 to 80% in equity, because that's somebody I know that is going to wake up really early in the morning. They're excited to go out and crush it. They're excited for the value creation that's going to happen inside the company. That's total alignment with the firm. It's age specific. Someone who might be in their 60s might want 70 to 80% cash, which is totally fine too. But you're right. Equity is back in vogue. Very similar to what we saw during the dot-com era where, people who might have had lower level positions became millionaires because they were in the right place at the right time at Yahoo or Google or
Yeah.
Amazon or one of those companies.
Absolutely. No, I think you summed it up nicely around you point to like a 60-year-old advisor, for example. People have various stages of their careers. Not everybody says I want 70% equity. The ability to be flexible, and I've always admired this about Lido, is you have taken a pretty darn bespoke, customized approach to all of your M&A transactions. Like I genuinely believe you view them each as important individual transactions in their own right. You're not cookie cutter and formulaic.
Yeah,
Agreed?
when you see one individual's personal situation versus another's, you've just seen one person's individual position. Everyone has a different why. Everyone has a different need, different size families.
Yeah.
Kids are in college, kids are out of college. So you have to be flexible. You have to be able to listen to what this individual needs, what their wants are, and figure out what is the best path forward and come up with the best possible alignment of interest between them and the firm.
And this is how you know you've been in the independent space for a long time, because a lot of the big firms, like the idea, you say it's so matter of factly, like you have to be flexible. Big firms are not flexible. And especially like something I was asking you around deal where you are super flexible. The wirehouse deal structures, they're not cookie cutter, but they are somewhat formulaic. A $20 million advisor does not get a deal that is so significantly better than, let's say, a $3 million advisor. And that is very much not true in the RIA space, in the space that you live in. So I point that out for our audience where like two completely different worlds. The idea of flexibility around deal, I think is probably foreign to a lot of the people listening to us.
Yeah, we're very transparent. So when someone comes in the office, even if they have a very bespoke ask, we'll literally sit in the conference room and we'll work the numbers with them. And there's always a path forward. And I know the individuals who've joined us have really appreciated the fact that we can call an audible, we can adjust on a moment's notice to make sure that they're comfortable and it's worked for everybody.
Yep, absolutely. Well, thank you for indulging me on the aside on private equity and M&A. We can shift gears now back to the core of Lido's platform. I want to talk for a second about technology. Maybe I'll give you a 2-for-1 here. Technology and or AI. So not alternative investments, artificial intelligence. Talk to me about how you view technology and the advisor experience. What are your thoughts on what this next year ahead looks like? Are you excited about AI?
Yeah, I'm very excited about AI. I just read an article online, I believe it was actually yesterday, so sort of a timely question. 80 or 90% of CEOs are spending money on AI, but only 5 to 10% are actually finding cost savings associated with the AI, with maybe a reduction in human capital. But AI is here to stay. How each company applies artificial intelligence to their operations and processes internally is going to be very different. We have at Lido, we recently have just hired 2 full-time AI specialists, and we have about 5 or 6 full-time coders inside Lido.
Wow.
And we are definitely allocating resources to improving the efficiency of every aspect, every operational aspect of our company. And really, step one is to build a very robust data warehouse. That's step one. Step two, simultaneous to step one, is to deconstruct each and every task that is performed inside Lido. And by deconstructing every task alongside the data warehouse, we think we can significantly speed up all of our processes and increase the efficiencies of everything that we're doing from an operational perspective.
It's super interesting. And I imagine this is one of those areas you were alluding to where scale helps, right? The ability to, the flip side of that is as you get bigger, clients might worry that the client experience will worsen. And I assume you point to if you're smaller, you can't hire 5 in-house coders and AI specialists.
Right. That's exactly right. Scale really helps. 5 years ago, 21, when we did our first transaction, I'm sure if I said to our private equity sponsors, hey, we're going to hire 8 people to focus only on deconstructing every process, right? And we're going to spend millions of dollars of the EBITDA you just bought. I'm sure that would not have been a well-received conversation.
You could have asked for a refund.
Exactly. But where we're sitting today, yes, we're spending a lot of money, but it doesn't move the needle, and it is going to increase operational efficiency. I believe it'll enhance margins. And I believe it'll actually be able to shift human capital from perhaps mundane tasks to more client facing opportunities, thereby enhancing the client experience inside Lido.
So, at a more basic level, the tech platform, I assume for an advisor who had their own RIA or was part of a different RIA, it probably feels pretty comfortable and familiar because a lot of the building blocks are, correct me if I'm wrong, somewhat similar. What is the general reception to the tech? And then the second part of my question is wirehouse advisors. To the extent recruiting more wirehouse advisors is a part of your strategy, and you can tell me if it is or it isn't, but what has their reception been to the technology question? Because that's, I think, where we get the question.
Yeah, when wirehouse advisors have joined Lido, the feedback we've gotten from them is wow, life is so much easier at Lido than their prior firms. And what I mean by that is we do so much for our advisors internally to give them back more time for them to focus on their clients. Tasks like, okay, let's bring in the new advisor as a prospect. We do all the work behind the scenes, reviewing the statements, preparing the presentation for this advisor. Whereas before, they might have spent hours in preparation, thereby taking hours away from their time for client service.
Prospecting, client service, yeah.
Yeah. So we've built a model where we do all the work for them. We prepare them. They read the reports we prepare for them, and they show up to the prospect or the client meeting with everything that they need. And we can do that. We've turned it into a 24-hour process. Give us 24 hours and we'll get you something back. And so between that and all of our other internal processes, our tech stack, we've made their life a lot easier.
No, I was asking because in fairness, right, those firms obviously have a lot more scale than you. So if the thinking is scale helps, especially in the area of technology, I think generally wirehouse advisors don't complain about their tech stacks. They complain about a lot. But usually with tech, they're like, yeah, it's good enough. It sounds like you're saying you view yours as an upgrade. And that's refreshing to hear. You would say your tech stack head to head against anybody's competes.
Absolutely. On the topic of tech stack and advanced wealth planning, some of the advisors who joined us from the large brokerage firms, they have complained and said, look, I have a client who's got 3 or 4 or $5 million. They don't have enough size to get an estate plan and to do a financial plan. Whereas at Lido, every client gets a financial plan. Every client can get an estate plan. So 3 or 4 or $5 million does not really qualify in the brokerage world to be considered size and to get the white glove treatment that we have designed inside Lido because of the scale that we've built.
So is that an important part of your strategy going forward, trying to recruit wirehouse advisors?
Absolutely. It is much easier to integrate an individual or a team versus a firm you buy with 100 people that has a different culture, right? That does take more time, more energy. But an individual or team, it is an easier integration, and that is part of our growth strategy.
It's an easier integration, but I think the transaction structure has been the struggle. Have you found success to date? Or is this something where you're saying, like, we think we got cracked the code on this and we're going to be able to ramp this up going forward?
We've had success. I wish we had more success with those coming from the big brokerage firms. The firms who are selling, it's a very conscious decision. Generally, they're going to market. They're represented by an investment banker. And generally, they're 95% of the way there as far as, yes, we're going to do a transaction. And I think in the broker world, generally just feeling things out. Do I want to do this? Do I not want to do this? And they're maybe 30 to 50% of the way there. And a lot of times they go through the motion, they meet 5 firms and they say, you know what? I'm going to stay for another 3 or 4 years. I'm going to give this more thought. So,
or I'm going to go from Merrill to Morgan and get 350% for doing that. That's the other reality of it, is you're competing against that also.
That's right. Yeah.
Yep.
Well said.
Yeah. No, I think that's really smart and I'm spot on. As I think through it, it's so, by the way, you're not alone in this. Most RIAs we've spoken with say, we wish we were doing more of this. We think we can and should be doing, especially the RIAs you would consider your peers, the big mega caps, right? It's hard. And I do genuinely believe it's coming. I think the access to private equity capital will help with that, especially you see some of the size of some of these breakaway teams. those teams lend themselves very nicely to this type of transaction, to affiliating or launching their own, but also affiliating with an RIA. I think it's coming. And again, when I say it, what I'm referring to is this idea that RIAs will be able to more directly help wirehouse breakaways. So I'm excited to have you back in a couple of years. This is one that we need to pull on a little bit more down the
Yeah.
line.
And look, like you said, success begets success. When you have a 3 or 4 or $5 billion team, they want to affiliate with someone who's at least 3, 4 times their size.
Yep.
And a $5 billion team is probably not going to feel comfortable joining a $10 billion RIA as they would a 40 or $50 billion
True.
RIA. And so as you see Lido and our competitors grow and scale, I think it's going to make it much easier for these larger teams to feel comfortable to go the independent route versus just taking another check for 350% of their trailing 12.
Totally agree with that. But do you still think, and you're entitled to say no, do you still think there's a place in the world for the wirehouses 5 years from now, let's say?
Absolutely.
What advisor in your mind would you say, I tip my cap to you, wirehouses are a good place for you?
I think they probably have, and again, maybe this is less true now than it was 5 years ago, but I do think they have a probably a stronger training program than some of the
Yeah.
RIAs. A lot of the RIAs are hiring people who've been in the industry 2 to 10 years, and the brokerage firms, and they have deep pockets. They're hiring kids right out of school and running them through their training programs. And so at Lido, we've started doing the same thing. We have about 30 interns coming in this summer, and it's great experience for them, but it's also a way for us to identify candidates for us to hire right out of school so that we can train them under the Lido way versus hiring someone with 5 years experience who already has preconceived notions from other firms they might have worked.
Yeah, I'm glad that's the example you went to because I try and be balanced and give credit where credit is due. I think that's one area where the wirehouses are still ahead of regional firms and certainly of independent firms is in their willingness. Training's expensive. I get it, right? Those are basically, you're talking about people who aren't generating any revenue for a long period of time. So they're probably best equipped to handle that kind of cushion. But certainly training programs is one. I guess the other area I would ask you about is not to harp on the question of brand. Occasionally we come across advisors who just feel like their success is so inextricably linked to the brand of the firm. Like Goldman is a good example of this, right? Where some advisors are like, I'm able to prospect clients because of the name on the front of the business card. And maybe what you would say is, correct me if I'm wrong, like if that's true, fine, but you should probably kind of sanity check that assumption because I think what we find is it's less true than people think it is. Like some advisors that think their clients are married to the brand and they may not really be, as long as they can be sure their assets are safe.
Yeah, that's a great question. And those who have left the brokerage firms where they were attached to a household name, a brand, and have gone independent can debunk that theory because they've achieved greater success, right?
Yep.
Outside of the large brokerage firms. And it's akin to someone who might have gone to Yale or Harvard and they thought, well, I went to Yale and I went to Harvard because number one, they're obviously probably brilliant, but number two, it's opened doors for them once they graduated. But after 10 or 15 years, what's more important, the 15 years of experience that they got inside a company or what's still showing up on their resume from 15 years prior? And we've all hired people from, second or third or fourth tiered schools who are much better than those who came from a top 10 school. So I think it really boils down to ripping off the Band-Aid and joining an independent firm. And I think what they will see is, oh my God, I really held myself back for the past 5 years trying to make a decision. I should have made that decision sooner.
We don't cherry pick our podcast guests. Every breakaway guest we've ever had on the show, almost to a man or woman, the feedback is, I wish I did it sooner. I should have done it sooner. It's a scary decision. It's a hard decision. And I think there are some kind of limiting beliefs that advisors have about brand and about their ability to move assets. But your analogy, I think, was brilliant. And it's almost this idea of what got me here isn't necessarily going to get me there. People outgrow firms, people outgrow models, and that doesn't mean the wirehouses are inherently bad. So thank you for indulging me on that. I think you gave a thoughtful, diplomatic answer. I don't want to get into any trouble. Couple more kind of rapid fire here. Consolidation in the industry, big trend. What inning do you think we're in? Or do you think next year we see this accelerating rapidly? You can answer either way.
Yeah, look, consolidation in the industry is going to continue. Private equity firms are not valuing growth via acquisition and M&A like they used to. Maybe 3, 4, 5 years ago, you can go out and buy 30 different firms and say that's an RAA, even though it doesn't have a culture, and get a high multiple.
Yep.
But what I've experienced over the past 12 months is there's a hyper focus on organic N&A. With that said, you're going to see continued consolidation in the industry. You're going to see some of the larger firms buying large firms. And you might see a $50 billion firm buy someone with 20 billion, whereas 5 years ago, that $20 billion firm would have traded hands between different middle market PE firms. So I think the next 5 years, you'll see a lot of consolidation. It's just going to be done differently than we've seen in the past 5.
Oh, that's an interesting take. So does that lead me to believe that you think multiples have room to run as well?
If you have true organic M&A, sky's the limit on the multiple.
Yeah, I feel that way too. If you're a good quality firm, top of the food chain firms.
Yep. If you're going to market and your N&A is basically flat and your only growth is the market, multiples won't be as aggressive as they would have been 3 years ago. Now, with that said, there's still lots of competition. And so you'll go to market and there might be 5 firms chasing you. And the hope is the firm that you're acquiring isn't just trying to take the biggest check. They're looking for the right cultural alignment, but that would be a little too altruistic. And it's a combination of both alignment and the size of the check and the multiple.
I think that's fair. Like, I don't begrudge people for taking the biggest check. A way I hope advisors approach it is, let me do a thoughtful diligence process and narrow this down to, like, let's say 3 firms where I think I could really reasonably run my business, be successful, grow, be happy. And then from there, fine. If you want to say the check is the tiebreaker, the decision-making factor, I can live with that. That's in my head anyway. How I think
And
about it.
I think it's important for them also to look at each firm's leverage, right? Because with private equity, some firms are levered 3 times EBITDA and some firms are levered 10 times. And also, we talked about equity earlier, Jason. If you're going to take equity in a firm, what are the prospects that the equity you take is going to go up 2, 3, 4, 5x over the next 5 to 7 years versus just 1.5x? It's harder to go from 100 billion to 200 billion than it is from 40 billion to 80. So size does matter on large and small.
I agree with that. We have this concept we call reverse due diligence, where advisors, especially if you're going to take meaningful equity in a deal, you should ask important questions like you would of any other investment. Unfortunately, I think what happens a lot of the times is advisors look at firm provided pro formas or models, and firms put their own assumptions on their equity valuations. So you look at a deal sometimes and advisors are like, look, they offered me 1,200% of revenue, right? We see this sometimes. So to your point, it's not just taking the firm's word for it. I think it's going a level deeper, especially for advisors who have concerns about things like private equity ownership and what is the future direction of the firm. Like, I would want to know who owns the firm, what are the off ramps, how levered are they? I think that's good advice.
And sit down with the firm and say, I want to take a look at, let's look at your revenue growth. Let's look at the NNA. What kind of assets are you bringing in? How are you bringing it in? Do you have a digital model? Are you going to feed me leads? There's so many different things that the advisor should be asking when they join a firm.
Yep. All right. I got 2 more for you. I saw an article, it's probably 2 weeks ago now. It was Ken Stern. He was quoted as saying, one brand, one vision, one shared ideology. That's Lido's North Star. I like the quote. Is that just a reflection of your concept that, like, when we acquire, we want these firms to look like us? Like, tell me more about this statement and why it's so important.
Yeah. And that sort of coincides with my McDonald's and Ruth Chris concept. And one flag, one name, one banner, one messaging. It's Lido One. We're one firm. We're not 364 different P&Ls that are combined under one name. And when our clients sit with an advisor in Texas or sit with an advisor in Florida or LA, I want them to all have a very similar experience. And we work really hard about having a commonality of the messaging, a commonality of the experience. And look, every client's looking for something different. And every advisor, they're human, they are different. But to try to bring that together in one experience has worked, number one, and has yielded extremely positive results with an outsized retention rate inside our firm.
I love it. I assume that's one pillar you plant your flag on. That's not going anywhere. But my last question for you, 5 years from now, we're having this conversation again. Tell me where Lido is. What's changed? What's your hope? What do you think looks different?
Yeah, 5 years from now, I hope we're close to 200 billion of assets under management.
That's more than a billion, right?
Yes,
Yeah.
200 times more than a billion. But I want to make sure that during that growth, our culture doesn't change. The client experience doesn't change. I want our clients to receive a higher level of white glove treatment than they're already getting, because success begets success. I want to reinvest in the company, in our people, in our processes, and in our tech. And I want the firm to feel the same, just be larger and deliver higher and better services.
I love it. Thank you so much, Jason. This has been an absolute blast. The firm is impressive. I thank you for sharing a part of the story with us. Really looking forward to having you back on in 2030.
Yeah, thank you so much for having me. And this has been a lot of fun. So thank you, Jason.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibility seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.